It's time for Yahoo Finance's Market Minute. Stocks mixed. The Dow and S&P 500 you can see are under pressure. The tech-heavy Nasdaq just above the flat line here as investors digest the escalating trade war. Delta Airlines cut its flight expansion plans and said it can't reaffirm or update its full-year guidance. The CEO saying uncertainty around tariffs is leading to disappointing bookings, calling Trump's policies, quote, the wrong approach. Delta shares are continuing to move to the upside now. Walmart walking back its first quarter operating profit guidance, citing tariff risks. The retailer saying it wants to, quote, maintain flexibility to invest in price as tariffs are implemented. Walmart shares are higher by about 3%. And shares of pharmaceutical stocks under pressure after President Trump confirmed tariffs on the sector are coming very shortly. Trump did not provide guidance on when the announcement could be made, what will be targeted, or how much the tariff will be. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. One portfolio manager reveals 3 tips for investors to navigate the current market turmoil. And should Americans expect a recession this year? We'll hear one wealth expert's view. Plus, tech support. Today we discuss what tech gadgets you can consider buying if you're worried about tariffs. And finally, all week on Wealth, we're talking about home buying as we head into the busy spring season. Today, we're bringing you the guide to the home search and the offer. You do not want to miss that. We've got much more coming up during today's show. But first, we take a look at some of the market action. We're 90 minutes into the trading day, and right now we're kind of looking at how we began today's trading activity here. Stocks mixed. The global trade war escalates. President Trump's 104% tariff on Chinese imports taking effect, and China retaliating with an 84% tariff on all U.S. goods. Joining me now, we've got Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Good to have you back here with us, Matt. The past few weeks, we've seen a lot of volatility. You have 3 tips for investors to navigate this market turmoil. Lay them out for us.
Yeah, thanks for having me, Brad. Yeah, so 3 things I would really lean into if you're an individual investor here is first, focus on diversification. Just looking at the levels of volatility across the investment landscape today, we're at near 5-year highs in terms of equity volatility, currency volatility, as well as fixed income volatility. Those things can be very difficult to manage unless you're well diversified. And so I think lean into diversification in terms of equity exposure, both in and outside of the United States, real assets, as well as high quality fixed income. When you fit all those together, you're able to better navigate really volatile environments like we're in today. Secondly, I think in terms of another tool to use is time horizon. The markets are digesting a lot of policy uncertainty today, and that's not necessarily resolved in the next month or the next quarter, or even the next year. And so, an appropriate time horizon for us, we think that's more in the 3 to 5 year is more likely to capture a lot of successful outcomes if we have an appropriate time horizon. So that's the second point. And then lastly, one of the interesting tips that you can do as an individual investor is in a calmer situation, outside of trading hours, think through some of the best companies you can think of, and think through some of, in terms of valuation, a ridiculously cheap price that you'd be willing to pay for that company, and put that in as a buy limit order. And if you happen to get it, if you happen to get a fill on that order, you really kind of feel like you're taking advantage of the volatility in terms of getting a dislocated asset at an attractive price. And so those are 3 things to just keep in mind as we're kind of navigating really choppy markets here.
Matt, we often hear this phrase, buy the dip, but how can investors determine which dip is viable, what dip to buy, and how to go across kind of their own checklist as they're looking at a lot of dips right now?
Yeah, I think that's a really tough question to answer. I think buying the dip, is always easy to do if we're looking in the past. It's harder to do when we're in the present. And so looking at today's environments, who knows whether or not the levels we are today are indeed the levels that, when we look back a few years from now, we're the bottom of the market. And so, if I were in your shoes, or one of the shoes of your viewers, I wouldn't necessarily hold myself to nailing the bottom. I would just look across the investment landscape and say, these are good values today at these prices. I'm willing to step in and have the appropriate time horizon to have a successful outcome 3, 4, 5 years down the road. And so, I would say, continue to stay diversified in this environment, and put capital to work in a diversified way. That's your best bet for navigating volatility in this environment.
What's your top equity or stock idea for us right now?
In terms of individual names, put aside the comments of the diversification, companies that to me have higher quality characteristics make a lot of sense in this environment. They tend to have pricing power to offset a lot of the trade back and forth that we're seeing in the headlines today. They tend to have kind of more stable end markets. And from a balance sheet perspective, they tend to be also better equipped to handle ebbs and flows in the economy. And so a name like Intercontinental Exchange makes a lot of sense to me in this environment. Just looking over the last 12 months, volatility actually is a boost to their fundamentals in their exchange business. We've seen volumes in the futures business up roughly 30% year over year. And then if, let's say that policy uncertainty translates into macroeconomic downside, to me that means interest rates are likely moving lower with the Fed coming back into easy mode. That's a tailwind to ICE's mortgage business in terms of mortgage activity, coming off of roughly 20-year lows back to growth territory. And so that's a name that I think is uniquely positioned, given its high quality characteristics and a little bit of defensiveness in the business model that can operate well in this environment. And
what about the bond market? How should investors be playing that right now?
Fixed income to me is attractive here. And when I say that, that's a big market. Specifically, I'm talking about high quality fixed income. And take the 10-year Treasury as an example. There's been a move higher in the last few days, in my opinion, driven by a lot of deleveraging, as well as sticky inflation expectations and the lack of probably Fed stepping in, at least right now. But think about the risk reward from here. The 10-year Treasury is at 4.35. Shock interest rates up or down 100 basis points and put a 1-year time horizon around that. What's the outcome? If rates were to move higher by 100 basis points, your investment would be down roughly 2.5% or so. That's not a terrible outcome. Obviously, it's not ideal, but take the other side. What if rates rally? What if rates go down 100 basis points? What's the outcome? It's about a positive 11.6% total return. To me, that return skew in terms of what could go well versus what could go wrong leads me to say that this is an attractive investment, and it's well diversified against potential downside on the horizon for equities.
Matt, good to see you. Good to have you back on and continue the conversation. Look forward to checking in the future.
Thanks.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got senior reporter Alexandra Canal. And Allie, we're looking at Starbucks and Cal-Maine Foods. First up, let's set the scene for Starbucks. Starbucks getting an upgrade to hold from underperform at Jefferies. The analyst has had that underperform rating on the stock since September. The stock is trading near the analyst price target of $76 a share, just a little bit above that, even though shares of SBUX moving lower here today.
Yeah, and really Jefferies was starting at an already low point here. We've seen this massive retreat when we think about Starbucks shares since that market high in February, like you just mentioned, Brad. Price target of 76, we're trading at right around 78. So the firm says we're closer to those levels, and therefore that points to more limited near-term risk to the downside. However, the turnaround story here for Starbucks is still very, very challenged, especially internationally. We talk a lot about these tariffs. Starbucks has a lot of exposure in China, and if we take a look at the first quarter, total same-store sales was down 4% year over year. International down 4%. China in particular dropped 6%. So we have problems with the domestic economy. We have increased local competition that's weighing on international sales. So a bumpy road ahead. I think we have a bit of a lack of visibility when it comes to the earnings side of the equation. Obviously, a lack of visibility on the consumer side, depending on how these tariffs play out. So that brings the already below consensus estimates from Jefferies categories more in line, according to them. So, we'll have to see where Starbucks goes from here.
Yeah, and to your point, with that exposure in the Asia Pacific region, a larger question mark and uncertainty going forward about what the consumer mind share looks like in some of that propensity to spend towards either homegrown or local or domestic players in that market versus some of the U.S. grown and trying to break into that market as well or further penetrate. Also, we're tracking CalMaine this morning, saying it's cooperating with a DOJ investigation into the cause of rising egg prices, and that includes whether or not egg producers have conspired to raise costs or limit supply. Bum, bum, bum. All right, well, shares right now down by about 2.25%.
I mean, we've been talking about the price of eggs for quite some time, really, since all of 2025, and we will get another update on that tomorrow with the Consumer Price Index out for the month of March. In February, we saw egg prices rise 10.4% after a 15.2% upswing to kick off the year on a year-over-year basis. We are up nearly 60%. Now, that's largely been due to the bird flu impacting that supply. Economists have warned that that likely will continue. In 2015, the last time that we saw the bird flu, we did have a spike in egg prices that lasted for several months. So perhaps a little bit more bumpiness in the months ahead. But for CalMaine, I mean, sales have surged, earnings have surged, demand is still high despite these price increases. So the DOJ basically asking for them to show their receipts to make sure that they're not taking advantage of this situation. The company has said that they've taken steps to repopulate the supply, but that, they also want to diversify their business because the potential for perhaps another outbreak that could weigh on financials in the future. So the stock is up 3% over the past month, which is more you can say to some of these other names out there. But egg prices obviously a big focus point for consumers. And I mean, it looks like the pain, at least for right now, is not going away.
Yeah, the egg surcharge for my bacon, egg, and cheese over at Brooklyn Bagel has been removed. Yeah. It's been removed,
That's good, though.
So that's a good,
All right.
We're
Brooklyn
trending in the right direction.
There you go. Yes. We'll see you tomorrow.
Well, yes, indeed. Every day. Allie, thanks so much. JP Morgan CEO Jamie Dimon says a recession is a likely outcome of the recent market turmoil tied to President Donald Trump's tariffs. Likely, but not certain. And our next guest has a slightly rosier outlook for the U.S. economy. Joining me now in studio, we've got Raquel Oden, who is the HSBC U.S. Head of Wealth and Personal Banking. Great to see you once again. Raquel, you're saying that you're not expecting a recession here. Why is that, and where are you still seeing strength in the U.S. economy?
So, thanks for having me. And to that point of that question, so what I would say is I've definitely committed to a slower growth that we could expect in the markets. I say there are signs that could trend to a recession, so I want to clarify the statement, but we're not declaring recession at this point. A couple of reasons for that. If we take a look at what's actually happening, we take a look at corporate earnings. We predicted corporates would be up about 15%. We've now recasted that to about 11%, so slower growth. I take a look at what's happening with, inflation. 0.2 going up to about 0.1%, so that's a month-over-month increase that we can expect. But at the same time, if I take a look at how we're seeing consumer confidence, that's about 57%, so still within that reason. We take a look at what we're thinking about from an employment standpoint, 4.2%. But importantly, we think there's going to be a slight uptick with unemployment due to the tariffs, right? And so where I would say all of us are believing the tariffs are a temporary 90-day situation, which then says if this is really just a bargaining tactic, that's the reason why we wouldn't expect a recession. If this goes past that, that would definitely put us in line to potentially be leading into recession. So because most of us at this point are looking at the tariffs as more of a international tactic and not a permanent decision, which is why we're not committing to the statement of recession.
And so with that in mind, what are the areas that you could see the Fed potentially start to notice a trend that would then change how their assessment ultimately shifts rate policy as well?
So I think what you said here, I think the Fed has already taken, from an inflation standpoint, right? They've gone from 2.1 to 1.7. So they've already recasted that slightly, which I think is important. I think at the same time, I think what we have to really think about is what we've been telling our clients. It really is making sure we say what I call active management. And the reason why that's important is there are going to be certain sectors that will absolutely be impacted by tariffs, right? So if I think about where we were at the beginning of the year, we were very focused on tech, financials, we were doing industrials, and then we were doing health. Right. I would tell you tech and financials right now absolutely going to feel the impact of tariffs, right? So back to my statement of active management. So within your diversified portfolio, this is the time for you to really be focusing more on that healthcare and those industrials, right? So it doesn't mean get out of the market. And I also say, when I look at the VIX, which really actually is what I call the glimmer of hope, because you were looking for some good news here.
The VIX, the fear gauge index, as a glimmer of hope.
Glimmer of hope. Only reason why I say that is when it's above 40 plus, and it's about 56 right now. We've seen historically about a 16% increase in equity markets over a 12-month period, 75% of the time historically. So one would say at this point we're at 56%, and importantly, we have to actually watch that VIX, because if the VIX goes below 40, again, that tells you go beyond neutral on equities. We'd actually see that dip in the equities market, but I do think the glimmer of hope here is this could be a buying season for diversified portfolios. Let's really focus on those sectors that matter most. But importantly, when we look at equities, there is still opportunity out there.
So let's get to people's portfolios here. Where beyond equities do you recommend that people stay exposed?
Yeah. So the way I look at this, and it depends what is going on in your portfolio personally, I would say what we've really heard from our clients right now is that short-term cash need, like the concern there, right? So I could always say, stay focused on the long term. We know markets always recover. It's about diversification. I would say right now what we're seeing a trend towards is treasuries, for sure. I would say gold. The old classic gold is back. And, I would say the importance of hedge funds, right? And so it really is defining whether it's short-term needs or long-term needs. And in the short term, there are things that you should be focused on. And then, of course, back to my really important statement of that active management. It isn't sit and watch. You have to actively engage on diversification of those portfolios.
Just lastly here, you said that people should be comfortable with volatility in this current environment here.
I didn't say should be. We'll need to embrace it because we can no longer control it. And the reason why I say that is if I take a look, since the beginning of the year, we've seen the Dow close up or down by 1,000 points 6 times this year. That's extreme volatility.
Yeah.
So, I mean, we can use the statement, but when you're seeing that extreme volatility, it really means you have to get comfortable with embracing that, because when we say uncertainty and volatility, it's going to be extreme volatility that we're going to see.
Even with that in mind, it's hard not to look at your 401k and not get nervous here. So what's your advice to investors to help stay the course that they may have charted going into the volatility?
You're correct. So that's why you have to separate short-term needs versus long-term needs. And that's really the logical answer you have to give yourself. And so you just said 401k. That is a long-term need, right? So you shouldn't be reacting based on the extreme volatility we're seeing for this period of time. But for short-term reasons, if you need to have that cash on hand, you really shouldn't be in the market for short-term reasons right now because of the extreme volatility.
Raquel, great to see you. Great to have you back in studio.
Thanks for having me.
Absolutely. Coming up, everyone, protecting your portfolio from volatility near or around retirement age. We'll continue the conversation and be back with some advice for you after the break. Stocks higher this morning, fighting for gains. After President Trump's tariff announcement sparked a massive sell-off, we are now higher, but we've been mixed. We're going to continue to see how this trends. Many people are watching closely and anxiously checking their brokerage and retirement accounts. And if you're younger, the good news is time's on your side. But if you're nearing or at retirement age, you may have some serious questions about how these losses will impact your money. Joining me now on set, live and living color, we've got Lizetta Rainey Braxton, founder and CEO of Lizetta & Associates. Lizetta, good to see you again. We're going to cover some different advice for different groups around retirement and age. So what moves can you make to protect your finances amid this market uncertainty from tariffs if you're, say, 5 years out from retirement?
First of all, I want to make sure you've taken inventory about where your retirement accounts are. So many people are still holding assets at their former employees, and you don't want your ex managing your money. So make sure you know exactly how many accounts you got out there, what the balances look like, and what buckets they're in, whether it's stocks, bonds, cash, publicly traded real estate, and of course, whether it's domestic or international. So your first step is taking inventory to know what you have, where it is, and if you're comfortable with what it looks like.
And so 5 years out from retirement, I would imagine that your risk propensity or your risk appetite is probably diminished quite substantially versus those who are further out from retirement here. So what should a solid mix look like in some of the risk exposure that you still have in your portfolio, even with some of the market pullback that we've seen?
Well, I'm going to use the it depends, but kind of bring it in some. So 5 years out, you're thinking about what your lifestyle plan is going to look like. Are your expenses increasing because you want to travel more, or are they going to decrease because you're just consolidating? And that's going to determine how much you need to take out from your retirement accounts. The other question is, too, do you have any other supplement accounts like brokerage accounts? Cash is going to be important as well, too, to give you some wiggle room so you don't have to pull out so much from your nest egg right away. Do you still have pensions? Are there annuities? So the key is really knowing how much you're going to need to take out from your retirement portfolio, and that's going to dictate how much you need to really kind of think about in having cash available now to ease you through the transition or not.
Now, what if you woke up, one morning over the past couple weeks and you were saying, you know what, today's the day. I'm going to hit that button. I'm going to let them know I'm planning to retire soon. And then you look at the markets and you say, okay, well, I don't know what my calculus should look like. Hey, what if you are considering retiring right now?
If you're considering retiring, you've already thought about it. Yeah. It's usually not a kind of, you wake up in the morning and say, okay, I'm going to do this with no planning ahead of time. So the hope is that you've been there, seen that before. Now, mind you, these are some unusual times. So the first thing you know is not to panic. Go back to that lifestyle plan. Figure out if you need to make a few adjustments. Maybe it's more of a part-time schedule you're working on until you're emotionally comfortable. And you said in terms of checking the numbers, sometimes having an advisor to kind of run the numbers will also help as well too.
What if you are currently retired, actively just living your best life, coasting on what you've already saved up in that nest egg?
You're saying, man, I know what my lifestyle is, and this inflation that's happening sucks. You have to be real about that. And so my hope, as retirees understand that kind of 30-year decade, 30 years, 3 decades, 20 years, that there are going to be some ups and downs. And so maybe you don't take that trip this year that you're accustomed to taking that costs you $5,000 to visit the grandkids. And maybe you say, okay, maybe you all have to visit us.
Lizetta, thanks so much for taking the time here with us today. 30 years, to be retired for 30 years, I can't wait to do that. I'm going to try and do that. I'm going to try my best. I'll report back. Lizetta, appreciate it. Good to see you. Coming up, airlines are losing confidence in consumer demand just as summer travel season is approaching. We get the skinny on travel spending and those trends next on Wealth. We are 2 hours into today's trading activity. Let's get a check-in on the major averages, plus a look at what's under the hood as well. The Dow Jones Industrial Average right now, that's holding on to some fractional gains. It's touched both sides of the trade here intraday as we're taking a look at some hyper oscillation, some waffling as we're searching for direction. The Dow Jones Industrial Average still holding on to gains right now by about 0.2%. The NASDAQ Composite, which has been positive for the majority and in fact all of today's trading session, that's holding on to gains right now of about 1.1%. And the S&P 500, you're seeing that up fractionally by about 0.4%. Similar activity there. We did touch negative territory out of the gate and later on at the top of the 11 a.m. hour. We'll see if we can hold on to these fractional gains. Big tariff energy rattling the markets right now. Unfortunately, we're seeing even more of the retaliatory activity certainly start to be priced in, and markets and some of the economists out there, even heads of major banks like JP Morgan Chase CEO and chair Jamie Dimon, coming out and saying and predicting, offering some of their own recession calls here, and that certainly is being factored in at least to the mindset of traders here today. Also taking a look at some of the NASDAQ 100 components. We're taking a look at some gains here for Apple. That's up by about 4.3%, catching a bit of a bid there. You're also seeing Nvidia, Amazon, and Google in positive territory. Some good gains for Microsoft as well here as of right now. Meta, one of the only Mag 7 pullbacks that we're seeing on the day, that did touch positive territory, has touched positive territory and been there for the majority of the trading session. It is down right now on this check-in. And TSLA, Tesla, they are up by about 4% right now. We'll just ride out with a quick look at the 11 S&P 500 sectors. Technology, yep, leading the pack. And then pulling up the caboose, you've got utilities. We are relatively split for the 11 S&P 500 sectors. Looks like we've got one more laggard than advancer, though, on the S&P 500 11 sectors. Switching gears. Airline executives started 2025 optimistic about travel demand growth, with Delta Airlines predicting it would be its best financial year ever. Now, President Trump's tariff policies are sparking uncertainty around the health of the economy. Delta, American, and Southwest have all warned that demand may be weaker than expected. Here with insight into how consumers are thinking about travel spending, we've got Haley Berg, lead economist at Hopper. Haley, this has been remarkable to hear how Delta has kicked off the conversations and what we've seen from some of the forecast revisions that have come forward. What does this all mean for the traveling consumer?
For consumer, it really means we need to be looking forward to summer and how travelers are going to approach the busiest travel season of the year, their summer vacations. Typically, summer vacations are seen as an inflexible event, something that families plan for, both in their schedules, but also in their finances. We'll definitely be keeping a close look on how early in advance travelers are booking those trips and whether they are beginning to show signs of what we call deal-seeking behavior that are typically something that flare up during times of economic uncertainty.
You know, since it's fresh here this morning with Delta's earnings, I want to play for you just a quick soundbite of what Delta CEO Ed Bastian had to say to us about what they're seeing in the outlook, and we'll get your reaction on the other side.
You know, I want to be cautious because this is early April, and we know the level of uncertainty we have is a bit unprecedented. So I would say that, you know, at the present time, it's shaping up to be a strong, not a great season. Great would be the plan that we had, which is 7% growth for the year. I think our revenue, the word I best describe our revenue at the present time across the board is stalled.
Haley, with that in mind, how does this potentially mean that consumers may shift where they're deciding their destination is going to be during the travel season?
You know, what we've seen historically is that during times of economic headwinds or times of higher prices, consumers don't eliminate their travel expenditure. They typically just approach that expenditure a little bit differently. They might trade out one destination for another. During the 2007 to 2008 or 9 time of economic downturn, we saw travelers taking fewer trips, but spending a little bit more on each of those trips. So I agree that I think we'll continue to see demand for travel into this summer, how people approach what they're booking and what they're prioritizing in terms of expenditure. That's where we might begin to see shifts if families are thinking differently about their entire budget, not just their travel budget.
So as we're thinking about those destinations, where are you seeing the best deals start to emerge for this summer?
This summer, we're definitely seeing low prices in destinations where there's a lot of competition from airlines and entry of low-cost carriers. Portugal is a great example. It's one destination that has been hot for a couple of years, but continues to offer a really great deal, low cost to get there. And once you're there, in-country, food, lodging, all a little less expensive. So definitely deals internationally. And then, of course, domestically, continuing to see great deals to destinations that Americans love to visit, like those in Florida, California, and many of the national parks as well.
What are the best days to fly? Because I was running some analysis on some TSA passenger throughput data, and it looks like year-over-year comps are the weakest on days like Tuesdays and Saturdays. Is that what I should be planning my entire trip around?
I would absolutely recommend planning your trip around the quieter days. We typically see fewer crowds and also lower prices if you depart for a trip on a Tuesday or a Wednesday or a Saturday. So for some families, that's not an option, but for those of us who are flexible on when we fly, you can typically save as much as 25 or 30% on your airfare just by shifting your departure date. And my number one tip, do not fly on a Sunday if you can avoid it. You'll typically pay significantly more to return on a Sunday, take that 6 a.m. Monday morning flight if you have to be back for work or school.
And so long-term price outlook here, as we're hearing some of these modifications to outlooks and even capacity is going to be restricted, or at least the growth metric that they were using before, that's going to be reduced. All of those things considered, are we going to be looking at prices also moderate lower, or is that something that's expected to stay in the same range?
think it's too soon for us to know how prices are going to play out for the rest of this year because we're in a bit of a lull. We're after spring break bookings and we're before summer bookings. And we really need to tune in to what consumers are telling us in the next couple of weeks as they look forward to their vacations in June, July, and August. But overall, I agree with Ed that we are still going to see travel demand this summer. We might not see as great of growth as many of us had predicted. But keep in mind, the growth rates we've seen on travel demand coming out of the pandemic, 22, 23, 24, have been incredible numbers. So some of this might just be expected moderation.
Haley, thanks so much. Great insights as always.
Great to be with you, Brad.
Coming up, what you need to know before making an offer on a home and how you can make sure your offer actually gets selected. We've got tips for home buyers in the playbook next on Wealth. According to the Mortgage Bankers Association, mortgage applications rose nearly 10% to hit the highest level since September, as tariff-related uncertainty sent mortgage rates lower. Joining me now to break down what the data tells us about the housing market, we've got Yahoo Finance senior reporter Claire Boston. Claire, what do we know?
Hi, Brad. So to break down this data a little bit, we have purchase applications up 9% week over week, and then we have refinancing applications up 35% week over week. That is 93% higher than a year ago. But what we are seeing in this data is that this will probably be very short-lived. This was a result of basically anyone who was able to make a mortgage application in those days when Treasury yields and mortgage rates fell immediately after Tariff Liberation Day. We have since seen a complete reversal of bond yields here, and mortgage rates are headed back up. So I would not expect this kind of application action to last another week here, but things are changing really quickly, so we'll have to see.
In some additional data, Realtor.com found that U.S. home buyers put down record down payments in 2024. What does that data mean for the market right now?
Right. So this is just another sign that houses are still really, really expensive right now. I believe those down payments were up 14%. Generally speaking, people don't typically put 20% down. It's more like 14% on average. But still, whenever you see that number go higher, it just means that housing is more expensive. It's going to take people longer to save. And I think right now people are looking at their down payments and they're a little scared, especially if they have them in the stock or the bond market. Just kind of seeing how far markets have fallen in the past couple days. It's a scary time maybe if you're thinking about making that home purchase decision, but you haven't actually put money down yet.
And finally here, the National Association of Realtors found that homeowners spent over $600 billion on remodeling in 2024. So what projects should potential sellers be looking at?
Right. I think with remodeling, it's quite interesting. People think that they need to redo their bathroom or redo their kitchen, but actually it's a lot of the smaller things that really move the needle and help houses sell. A lot of the realtors in this survey are suggesting paint your whole house, even just paint a room, anything to kind of like brighten up that space a little bit, potentially redoing a closet. They also said that, just adding a new front door, relatively cheap things are really what potential buyers want to see.
All right, so maybe put down that matte black pint of paint that you were thinking
white,
about picking
I think
up.
is the way to go.
That's the way to go. Okay. All right, Claire, thanks so much. Appreciate it. It's Housing Week on Wealth, and we have the Home Buyers Playbook with everything that you need to know about every step of the home buying process, from the planning stages to the closing process to the first year of home ownership. And today, we're diving deep into the process of making an offer on a home. Joining me now, we've got Melanie Atkinson, Realtor with Compass. Great to have you here with us. So what do prospective home buyers need to know about working with a realtor? Walk us through their role throughout the home buying process.
Yeah, well, we know that 88% of home buyers use a realtor because the process can be confusing for people. So what they need to know is that their realtor is going to work with them to be their home buying project manager. They're going to help them get access to houses. They're going to help them do research on the homes, even off-market listings. They're going to help put the team together that will help them through the home buying process, like lenders, insurance agents, inspectors. They're also going to help you understand your contract and negotiate it. And they're going to navigate the inspection and repairs process, everything that needs to be done to get you to the closing table.
So explain how a buyer-broker agreement works.
Yeah, so that's been a big change in our industry in the last year. So buyers are now required to sign a buyer broker agreement with their broker agent that specifies the duties of the buyer broker. It also specifies compensation. And a lot of buyers can get nervous about signing a contract that says they have to compensate their buyer's agent a certain amount. But a good agent will be able to use that as part of the negotiation of the house itself. It is not unusual for sellers to still contribute to the buyer's agent compensation. And in Florida, where I work, we still have a lot of sellers that are outwardly offering buyer's agent compensation. So we don't want buyers to be afraid of it, but we want you to get an agent that understands it and can explain it to you and negotiate it properly.
So what do prospective home buyers need to do as they get ready to make an offer?
Oh, sorry, I thought you had more of the question. So whenever they're ready to make an offer, they want to make sure that they have their pre-approval letter ready. They want to make sure that they're going over all of the disclosures that the seller is providing. So homeowners association, condo associations, they definitely do not want to get stuck in a situation where there's some special assessment that they didn't know about. So check those disclosures. You also want to have your agent look at recent sales and pendings so you can make an educated offer. And then really important is to consider all the costs of homeownership from a monthly budget perspective. Don't just look at your mortgage payment. Make sure you're paying attention to insurances and extra homeowners association fees and, of course, taxes.
Now, you also have some tips to help prospective home buyers and get their offers selected. What are those tips?
Yeah, so it's not all about money all the time. Obviously, that's the best way to get your offer to stand out is to offer more. But really finding out what the seller's motivation is. Maybe they need a long or short closing. Maybe they need a lease back where they are getting out of the house over a month and allows them an easier transition. There's a lot of different things that you can do with your lender. You can have the lender call the agent and the listing agent and explain that you are a well-qualified buyer so the sellers aren't nervous about your ability to get the loan. One thing that we do here in Florida is we have shorter contingency periods, which tightens up the contract and makes it more desirable.
I was going to wager a guess that you were in Florida based on the Tampa Bay Buccaneers paraphernalia behind you as well.
Yes, Lightning and Tampa Bay Buccaneers.
Yes, yes, indeed. And so all those things considered, as you're looking at the Florida market versus what we've seen perhaps down payments more broadly on an aggregate scale, what is the comparison that you're seeing and how hot is the market down there?
Well, the market has definitely cooled off a little bit from the COVID years. It was crazy here in Florida during the COVID years. So we are more working towards a balanced market and even a seller's market, a buyer's market in some situations, especially condos. We have a lot of inventory of condos. It's a very complicated situation with the condo market down here. But in general, we don't have the same amount of people coming down here. It doesn't mean that the market is distressed. It just means that it's slowed down and it is a little bit more balanced, which is really great for buyers because they have a lot more leverage now than they used to a couple years ago.
Melanie, thanks so much for taking the time here and breaking down some of the expert tips for folks who are getting out there and perhaps doing some shopping this weekend. Appreciate it.
You're welcome. Thank you.
Coming up, not sure whether you should buy an iPhone with new tariffs in effect. We're breaking it down next. According to Bloomberg reporting, Apple stores in the U.S. saw increased foot traffic over the weekend as consumers worried about how President Trump's steep tariffs would impact prices. So for this week's Tech Support, we take a look at all things tech. And Yahoo Finance tech editor Dan Halley is here to help break down whether some of your favorite gadgets could see price hikes due to the trade war. So let's talk about this. Is now the time to upgrade your iPhone or iPad?
Normally, I would say no. And honestly, at this point, there's no definitive answer as to whether or not Apple's going to raise prices or not. They'll just eat the tariffs, renegotiate with some of their suppliers, try to lower prices. But 104% tariff coming out of China, that's a big deal for Apple. They still have the majority of their iPhone manufacturing there. They do have manufacturing in other countries. India is one where they've tried to build out a lot of capability or capacity there for manufacturing. Vietnam, they're able to do stuff for things like the Apple Watch, the AirPods, but really for the iPhone, it comes down to China and India. It's tough to say whether or not now is the time, only because, and I generally say that just because we're going to get the next iPhone in September. Mm-hmm. Do you want to get the best one when it comes out? Is the best one going to be more expensive? Right now it's $1,000 for the regular iPhone Pro. I think if all things being equal, I would probably upgrade now just to get ahead of any potential tariffs. Gun to my head, I got to go out and buy a new phone. I'm doing it because I don't want to have to pay however much Apple might end up having to upcharge. The other thing that we're looking at is not just obviously the price that we could see, but what some are predicting. Dan Ives had said up to $3,500 for an iPhone if it was built in the U.S. Now, that's a very high number. It all depends. We're not completely sure. The reason for that is Apple has to build factories here. They don't got them. They have to get people who can build iPhones here. They don't got them. And then obviously the pay that you would have to pay those individuals. So it really is still hard. But for me, if I'm giving someone advice, I would say buy now, try to avoid those tariff prices.
This is just one part of the purchase decision. What about laptops and computers?
Look, I mean, semis are exempt, but that doesn't mean things with semis in them are exempt, right? And so that's the iPhone, that's the laptops, that's desktop computers. And so those are also going to be hit pretty hard depending on where they're coming from. Obviously, China, there's a lot built there. Taiwan has a lot built there, and other countries as well do a lot of manufacturing of these laptops, and the U.S. doesn't. And so anything from here, the laptops, desktops, you're going to eventually see some kind of price increase from third-party manufacturers, whether that's going to be your HPs, your Dells, your Lenovo's, what have you. I think for me, especially on when it comes to something like this, a very expensive purchase. Usually laptops, desktops, they're pricey. I would absolutely buy one now ahead of tariffs.
Just lastly, we got about 20 seconds left here. Video games.
They're getting smacked around pretty hard.
The consoles specifically.
Yeah. The Switch 2 was supposed to be up for pre-order today. I had it in my calendar, and they said, no, we're going to wait to see what the impact from tariffs are. They're built in China as well as Vietnam. Both of those countries are hit with tariffs, China obviously being the bigger. And so, if you lived in the UK, if you lived in Japan, you were able to pre-order them already. But Nintendo basically said, no, we want to figure out what's going on. It's still going to go on sale in June. Yeah. The pre-orders, though, they're delayed.
All right, time to make some friends in the UK, I suppose.
Yeah.
Dan, thanks so much. Appreciate it. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.